We also have Dipan Mehta, Director at Elixir Equity, joining us on the show. Deepan, hi, morning. First up, would want your take on Titan. Before that, let me just sum up what Titan's Q3 update looks like. Fairly, my first take would be that it looks like a good set of updates coming in. The consumer business growth has been good. Domestic business growth has been very robust as well. What has done really well for themselves this time around is the jewelry business, 41% year-on-year growth. Plain gold has more than doubled. Studded has logged its best ever performance yet for this financial year and has seen double-digit growth in mid-20s too. Watches has done very well for I guess the 7th or the 8th consecutive quarter. Eyecare has done very well, a 16% overall growth and a sequential recovery for eyecare too. What is slightly concerning is the little slowdown that we've seen in the emerging business, overall growth of just 14% year on year. Fragrances have seen a little bit of a pullback at 22% year on year. Women's bags, their newly launched or recently launched brand Earth has done very well, almost in fact more than doubled, but Taneira continues to be under pressure. Although that pressure has reduced, but still it's a negative 6% cut on Taneira. The international business continues to hold up well as well. Deepan, your view on Titan and your take on these Q3 updates?
Yeah, good morning and thank you for having me on your show. Broadly, first of all, the disclosure that we are invested in Titan has been a great story for us and delivered multi-bagger returns. And such numbers coming in, it's the second quarter in a row that such great numbers have come through. So we are quite pleased. And, although the stock is trading expensive at 88 times, it seems to have entered a new growth phase with the kind of numbers which we are seeing just now over here. In the past, apart from the last 2, 3 quarters, the growth rates used to be just about middling teens or so, but this kind of growth rate is phenomenal. Of course, a lot of it has to do with gold prices, because end of the day, they are their inventory, their sales are all marked to gold, and gold has rallied significantly in the last few months. So that's also taken the top line higher. Also, one point perhaps that you may have missed is that the gold coin sale has doubled. So that doesn't add much of profitability to the company, although it increases the top line. But nonetheless, I think rising gold prices somewhere do benefit the company, although there is lower demand, but they're able to extract maybe higher making charges because that linkage is there to gold and studded gem prices. Broadly, I would say at these levels, I would say more or less fully priced. But as an investor, we are remaining invested in it, hoping that the stock P multiple remains constant and long-term growth rates could easily be in the mid teens or so. So it's a nice stable performer and a great play on India's rising wealth and consumption. But expensive at these levels, maybe at a correction, who knows, maybe a good investment story.
Yeah, so that really stands out. Sorry, Sajid, for interrupting. But
consumer. Deepan, does GCPL stand out to you in terms of FMCG staples? In terms of your home care, personal care categories, is GCPL touted to be the top performer?
No, not really. I think if you look at the 10-year EPS growth, it has been 7.5%. And that's true for a lot of FMCG stocks. And we have been negative on FMCG for the past several quarters, if not years. A lot of the categories in the Indian FMCG have now reached maturity phase, and their growth rates, volume growth, will be in line with the population growth, which is kind of a low single digit. And you could have a great upswing in this quarter because of base effect, because of lower inflation, maybe premiumization, moving up the value chain. Those are the things which may still work for 1 or 2 quarters. But all those great numbers coming through from the FMCG industry are exit opportunities from the FMCG stocks per se. And this is one sector where there is a secular stagnancy coming through. So I would like to avoid it. Godrej Consumer in particular, I think they have so many challenges internationally that even if domestic business does well, something keeps happening in the international phase because of which the numbers never come through and valuations are rich around 60 times or so. So for me, every rise in FMCG is a sell. Of course, there are a few companies, which are in underpenetrated sectors. One could look at that. And the new FMCG, I call it, is like liquor stocks, beverage companies like Varun Beverages. I think they have far better scope for appreciation than the traditional FMCG companies, be it MNCs or even homegrown companies like Godrej.
okay, Deepan, I wonder how you also look at. And by the way, viewers, there's a Titan con call with regard to their latest lab-grown diamonds brand. And you will see some of those flashes appear at the bottom of your screen as well in rotation with some of the flashes which are already playing out. So you might want to keep an eye out on that. But Deepan, with regard to Titan and beyond, the kind of growth that it's clocked, 40%, and now you have a new lever, a new vertical. But Titan has largely relied on the kind of brand it has, allowing it to basically ensure reliability for the customer. In lab grown diamonds, there's no such differentiation. Do you believe that they can do the same thing? They can replicate that in lab grown diamonds? The reliability of buying from a Tanishq, buying from some of the other brands that they have. Can they replicate that with Beyond, given the fact that lab grown diamonds are largely neutral in terms of the quality and the make and the originality of it, if I can call it that?
See, I think that lab grown diamonds will become mainstream and eventually they'll form a larger portion of all the entire jewelry industry. But that's maybe a few years away. And right now, what is driving the entire industry is gold jewelry per se, because gold is traditionally what is bought by consumers. And now with the gold prices rallying the way they have, the case to buy gold jewelry also is better because you can wear the jewelry and it's an investment as well. So from that point of view, I think the entire jewelry industry is benefiting from that. Also, Titan and some of the other players, organized players, are benefiting from a very large shift from from unorganized to organized. And of course, they are rolling out a fantastic retail network to capture the customer, and then there's the wealth effect. So I wouldn't just look at Titan in new light or more positive because they have launched lab grown diamonds. It's like any other initiative which they have taken. And end of the day, if you see, Titan is still only about gold jewelry. They've done so many things, whether it is eyewear or whether it is some of Tenera, which does a lot of other products. The growth rates over there have not been as much as the core business of jewelry. So I would not read too much into it. It's a good natural extension for Titan. It was a missing piece. They're working on it. Who knows, 4 or 5 years from now, it could be a big part of the business. But I don't see it driving growth over the next at least 2, 3 years or so.
Okay, Deepan, your take on Jubilant Foodworks and your view on the moderation that we've seen for its like-for-like growth?
That's why I think even QSR is going the FMCG way. And the fact that Devyani is merging with Sapphire, clearly, they are trying to rev up the growth. Standalone companies maybe not able to do as much and trying to get the maximum efficiencies. And even the Jubilant Foodworks, we have seen that the same store sales growth have been pretty tepid and penetration also is pretty deep now. So I would like to avoid the QSR stocks, although there could be a trading rally in them from time to time. The essential problem is that the advent of these food aggregators has kind of dented the demand, especially the long-term demand for the QSR industry. Now there is just so much more choice for consumers to order food in, and I think not as much of consumers are going out into restaurants, QSR especially, and more of ordering in is happening because of the choice and the convenience. So that really is affecting the long-term growth rates of the QSR industry. So I would say that within the FMCG consumption QSR space, you are better off with a Zomato or a Swiggy than the FMCG companies or even the QSR companies. The real growth is coming over there. At some point of time, 3, 4 years from now, they will be solidly profitable and still be able to sustain about mid-teens type of growth rate. And these are really the stocks, of the next 4 or 5 years or so on a longer term basis, which can deliver super outperformance, assuming that they themselves are not disrupted.
Okay, and Deepan, just a follow-up on that. Now, we've seen this Devyani Sapphire merger happen, and on one side, you have the market leader Jubilant that is also starting to show weakness. Do you believe this merger could pose as a significant threat to Jubilant now that the like-for-like growth is deteriorating?
I think that in terms of competitive intensity, it won't make much of a difference.
Okay.
And the merger is all about extracting efficiencies more than anything else, so that the operationally once they're integrated, there can be some savings. And typically, that's what happens whenever an industry reaches maturity and growth rates slow down. The players within themselves start to think how they can grow, how they can increase their profits, and that's when mergers take place. That's the reality of a lot of industries, not just QSR. And that's what we are seeing over here, the merger between Sapphire and Devyani as well. And end of the day, I think they have to realize that growth rates per se are on a secularly slow growth. And it's not that these companies are really typically quite cheap, that you can account for such slowness in the long-term growth rates. You could have a quarter, 12, 13% type of growth rates, but long-term growth rates, I'm not so sure. Also, these companies, be it be it Devyani, or for that matter, Jubilant Foodworks, they're expanding globally and they're entering into new territories, and that brings itself new risks from an investor's perspective. We understand the Indian market, we know what are the challenges, what are the growth opportunities. When you go to Turkey or I think Malaysia or Thailand or any of the African markets, one doesn't really know how those adventures will play out. It could turn out to be positive, no doubt, but end of the day, it's just too many moving parts, and the fundamental business remains on a very stagnant kind of a slow growth rate. Look, 4-5% type of same store sales growth is not going to generate great value for minority shareholders.
Okay, Deepan, appreciate that view. Thanks so much for your time. And on that note, we'll let you go. Thanks once again.